Welcome back to the Week in Markets. My name's George Bell and I'm joined today by Sam Elliot to give you an update on some of the key developments through the course of this week. Sam, it felt like the market was becoming a little bit more relaxed on tariffs after Trump dialed back from the highest level of tariffs which he'd initially threatened on major trading regions, but it appears that not all's relaxed in the White House. We've just heard today a few more announcements targeting Europe and Apple. What's the latest?
Yeah, I think that's right. Thanks, George. Think back to sort of early April. As you say, we had some of those rollbacks on tariffs, 90-day pause announced. Also more recently, we've had the US and China officials meeting in Switzerland and more positive news coming out of that meeting. Mm-hmm. And the market's taken that really well. We've seen stock markets rally since early to mid-April on that news. But as you say, today that's developed. So Trump's really expressing his frustration with the lack of progress on discussions with Europe. And he's threatening to impose a 50% tariff on all European imports starting on the 1st of June. We've also seen him take aim at Apple as well. So a lot of iPhone manufacturing takes place in Asia, like China, India, Vietnam. He's threatening Apple with 25% tariffs on all iPhones unless the manufacturing's moved over to the US. If we just look at how the markets have reacted to that, we've seen equity markets fall on the day. So on the news, European equities were down about 2%. We've also seen US markets fall on opening as well. But just from a multi-asset perspective, maybe a bit more positive news. We've seen bond yields fall today, so getting a positive return on the price of bonds. And also gold as well. We've seen a really strong year to date so far for gold, and that's having another positive day today. So diversification really providing some cushion for multi-asset portfolios.
So he's serious about negotiating in this 90-day window. It's not a grace period. It's about bringing people to the table and trying to strike a deal for the US economy. We've been really flagging that whilst he has rolled back from the more extreme threats which he made, that there is going to be higher tariffs which are going to be imposed across the major trading regions, and that is going to be a headwind to economic growth, not only within the US but also internationally, given how connected it is with the rest of the world.
Yeah, and just the risk to inflation, I guess, as well, just given disruptions to supply chains and also obviously higher prices from the tariffs being imposed as well.
Absolutely.
And that's not all this week, George. So we've seen within the House of Representatives this week, Trump's big, beautiful bill, as he's termed it, be passed through in the House. So do you want to just touch on some of the details that we've seen there?
Yeah, absolutely. So he received the vote very marginally by one vote, 215 to 214 to be specific. And now it needs to go to the Senate for approval. But it's one step further. It's sort of getting over the first hurdle, and it's got a number of different aspects which he aims to put in place to turbocharge America, which are really aligned with what he proposed in his election campaign. So it's quite widespread, from removing the tax on tips and overtime, increasing child tax credit by $500 a year to $2,500 per year, state and local taxes, which are essentially what you pay to your local government in terms of taxes on income, on purchases, but also on property. And when you file your tax return, you can actually deduct some of these expenses from there. And in 2017, it was capped at $10,000. And what he's doing is he's adjusting this so it can be up to $40,000 for married couples, up to a limit of $500,000 there. So essentially, it's very targeted to higher income earners, and it's also targeted towards married couples. So it's quite specific. Also increasing the restrictions around Medicare, so making it less accessible. Really, he's trying to reduce the cost of medical spending in the US by the government. In order to do this, he needs more money. So what he's doing is he's increasing the debt ceiling by around $4 trillion. So that'll take it up to around $40 trillion now, just to enable to do all of this, which is really what the bond market's concerned about. The bond market's concerned about how we're going to fund all of this, and it's going to be funded largely through the increased supply of bonds into the market. And as a result of that, that's we're seeing bond yields which are sitting at an elevated level at this point in time, along with, as you mentioned, Sam, some concerns around inflation there. But largely it's the expanding government fiscal deficits which is in focus for the bond market.
And I guess just on that funding point as well, less money coming in from tariffs, just given that the levels have been lowered, but also on pause as well. Absolutely. So more of that has to be funded by debt, as you say.
And if we turn to the UK, we heard some UK inflation data this week. Are you able just to give us the latest?
Yeah, sure. So inflation was released for April. It was expected to rise, but actually increased by more than what was predicted by economists. So we had inflation at a headline level at 3.5%, and then the core reading, which strips out some of the most volatile measures, was at 3.8%. What's maybe more concerning is just this level of services inflation. So that's one of the most sticky components. And we actually saw that move back above the 5% level. So still a very elevated level. And as I say, more sticky, so not expected to fall anytime soon. One of the other contributors to that increase was just the hike in the energy price cap, which we saw come through in April. But that's expected to be more temporary, just given that we had news from the regulator this week after that release of data that the price cap will reduce in July. So more of a temporary measure, but really the services inflation more of a concern. I think this data really just provides an additional challenge for the Bank of England. So we already had the meeting earlier this month where we saw some disagreement within the Monetary Policy Committee. So we had some members voting for a one interest rate cut, which came through. But also on either side of that, we had some members voting for a more aggressive, so 2 cuts, and we had some members voting for no cut at all. So there's already disagreement, and this elevated inflation, which we've seen this week, is just going to provide an additional challenge to that. Markets, investors have been expecting maybe 2 interest rate cuts for the rest of the year. I think the probability this week of that second cut has just fallen slightly, just given the higher number there.
So bringing all of these different aspects together, quite a bit going on, but Trump's serious about US protectionism. The 90-day window is not so much a grace period, it's a heavy negotiating window. He's very keen to strike a deal with major trading partners. He's one step closer on delivering on his major fiscal spending package, which has really got the attention of the bond market. We are seeing some diversification in action there. You mentioned it's been more challenging today for equities and for the dollar, but we are seeing some support coming through from bonds and also gold within portfolios. And in the UK, still seeing the challenge of sticky inflation, which is really coming through from the service sector. So a challenge for the Bank of England. Sam, thank you very much for the updates. A lot going on, so please do tune in next week for an update here on Morning Markets.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.